What is selling short?
Selling short is basically selling something you don't own to profit from it going down instead of going up. Now, traditionally, the way to trade has been to buy low and sell high and make money as the share price goes up. But something that online trading, spread betting and CFDs has allowed clients to do is sell something they don't own and profit from the market going down instead of up. So all you would necessarily do, which is different to the other side of trading, that instead of buying initially and then selling at a later date, you would sell initially, hope for the market to go down, and then buy it back at that lower price and make the profit.
Is short selling legal?
Short selling has had a pretty bad ride of things recently because of how far the markets have moved, and short selling was blamed for a lot of the falls in the banking stocks. But short selling isn't necessarily a bad thing. It is nowadays something that is in the modern arsenal of any trader, basically, because it is such a key weapon in trading. In the past, of course, making money from buying low and selling high has been fine as long as the markets were going up. But of course, the volatility that we're seeing in the current financial situation means that that's not always the case. So as the market now goes down, short selling just gives traders the possibility to trade when the markets aren't going up and still make money as the market starts to fall lower.
What is the bid price?
There are two different prices when it comes to trading, and the bid price is often called the sell price as well. On any price that you get from a financial company or a trading company, whether it be spread betting, CFDs or stock trading, there will be two sides to the price. There will be a bid and an offer price. The bid price is basically the sell price, so that's initially where you will sell from. The other side to that is the offer, or sometimes called the ask price, and that's the buy price, and you will buy on that upper level. Okay, the buy price is higher than the bid price usually.
What is the offer?
The offer price is the price that you will buy on. There are two sides to the price, the bid and the offer price. And on the offer, that's where it's usually higher than the bid price, and that's where a client will put his buy order if he wants to go away and buy something. It is on the buy price that he will get, and that's the ask or the offer price.
What is the spread in spread betting, and how do I make a profit?
The spread is the difference between the buy and the sell price, and this is something key when you're looking for which spread betting company to trade with. You want to trade with the company with the smallest spread, because that means it takes less time for you to make money on your trade. So for an example, if I was to buy the FTSE 100, I'd obviously be buying on the higher price, and I would have to make money when the bid price, which is the sell price, went above the buy price that I initially bought. When that did that, I'd then be able to close the position if I wanted to at a profit. The wider that spread is, the longer I have to wait for my position to become profitable.
What is trading on margin in spread betting?
Trading on margin is a real big helping point for anyone that wants to trade on spread betting, but it has two sides to it. The good side of margin trading, it allows you to take on a position that you wouldn't necessarily be able to afford. It allows you to take on those larger positions and make more profit if the market goes your way. Of course, the other side to that is it will magnify your profits, but if the market goes against you, it will also magnify your losses. So margin's a fantastic trading tool if used in moderation.
What is the risk in spread betting?
Well, the risk in spread betting is pretty much the risk in any trading you do at all. There's no more risk in spread betting than there would be in traditional stock trading, CFDs, trading foreign exchange, whatever it would be. Your major risk, of course, is the market will go the opposite way to which you bet. If you buy something hoping for it to go up, the risk is that that price will go down, and vice versa. If you short sell, the risk is that that market will go up and you'll start losing money. But there are ways that you can counteract losing money and protect yourself. But they are the major risks in the market basically going the wrong way which you trade.
How do I manage the risk in spread betting?
Well, there are a number of ways you can manage your risk in spread betting, and risk management is the most important thing when it comes to any form of trading, not only spread betting. The major way people tend to manage their risk is to use different orders such as stop losses and limit orders, and most specifically a stop loss. What that stop loss will do is it will allow you to basically pinpoint a worst case scenario for your trade, and as the market goes against you, you'll be able to set an order to close you out of that position at a level that you feel comfortable with. Without a stop loss, then of course the market can go as low as it wants to without you necessarily being able to close out of it.
What is a stop loss?
A stop loss enables you to protect your position. A stop loss is an order that you put into the system at your worst case scenario to say, if the market goes against me by a certain amount, I want this order to automatically close my position and take the risk away.
What are limit orders?
A limit order is basically done opposite to what the stop loss is. If the stop loss is there to protect your position, the limit order is there to take your profit. You put the limit order at basically your best case scenario. So you put it at a target you have in mind, and when the market hits that target, it will automatically take you out of your trade at the profitable position without you having to actually do it yourself.
Will I have to constantly check the market prices?
Some people like to do things differently. You don't necessarily have to be stuck in front of your screen all day long. The stop losses and the limit orders, which are where I work, called pending orders. These orders allow you to put an order into the system, put a request into the system to trade at a certain price. And that means that the market, there won't be any trades put on your account until those certain prices are hit. Now this means that you can leave your computer screen, you don't have to check the prices, and you can check them every now and then to make sure to see if your trades have been hit or not. Because of course it's not necessarily realistic for everyone to be able to check the screens all day long. People have jobs, they go out and do other things during the day. So being able to place these orders gives you the flexibility of being able to trade basically whenever you want. The company I work for there's a number of different platforms you can use, and a lot of other companies have the likes of mobile trading as well, which means you can trade on the run as well.
How can I protect myself in the current turbulent economic climate?
The one thing that clients look for, especially when it's spread betting and online trading, because this gives you the availability to go into the market whenever you want and place trades, volatility, and the volatility we've got at the moment in the markets, is a good thing. So when we do get that volatility, it enables you to go in, place trades, and get the movements pretty quick. Now, of course, that only happens as long as you protect yourself with the risk management tools that are in place. But you also, it is an amazing opportunity for you to go in and make a decent amount of money on quite a short space of time, as the markets tend to move around very quickly.
How do I go about choosing a spread betting company?
Well, when it comes to spread betting companies to trade with, there's a number of different things you're looking for. Now, of course, the one key thing about spread betting is it's the cheapest way to trade. But there are some costs involved in it. So when you're looking for a spread betting company, you're looking for the company with the tightest spreads, which means it's the cheapest for you to trade on. Those companies with the tightest spreads mean that when you go in and you place your trades, it will cost you far less than what it would do with a company with wider spreads. Also, what you're looking for is of course, number of instruments offered. If you're looking for something to trade on, you want to trade on something a little bit more obscure, you need to make sure you trade with a company that has a wide range of instruments on offer.
Where can I find out more about spread betting?
You can find more about spread betting pretty much all over the internet. Spread betting is an online trading tool, so all over the internet there are a number of places you can learn about spread betting, trading in general, and different sorts of trading tips. And a lot of companies, spread betting companies, offer you advice and education on trading as well. So the best way to search it is to go onto the internet and basically search for spread betting. You'll find all the information you need.
www.busybox.com